I tell you, it's been a trying time. As good as things have been this summer for both crop people and cattle people, uh, it certainly has had some struggles. So, Aaron, can you still hear me?
Yes, yeah, we can hear you, and
Oh,
your
okay, sorry. It's
summary's
some
fine. Yeah,
like there was the something just disappeared and I didn't know what happened. Sorry about that.
nope, you're good.
So I was a little confused. But as good as things have been during the summer, we have run into several struggles here in the fall as concerning cattle prices, and and I mean the bottom line of it is cattle prices are still really strong relative to what we've seen since 2016. So despite the fact that we've had stronger prices a couple of months ago than we do today, doesn't mean that today's prices aren't still really good. Now, the people that hurts are those that are buying and selling cattle, those margin operators, stockers, backgrounders, feedlots. The cow calf guys still in a pretty good situation because they have their set cost of production for the year, and they're still selling cattle on a strong market, though not as strong as it was maybe in September, October, and even back into August and July. But the one of the main things that needs to be talked about is that drought is still influencing this heifer retention, and I'm going to show a couple things of cattle on feed towards the end of the presentation, and that might be where I spend most of my time uh, talking about what's really impacting this market in the current time period. There's we want to say that the changes in prices or the changes in expectations of prices, which would be the futures market, are caused by a single thing. Same thing with when fuel prices, when oil prices go up or down, we always want to say it's this one thing. And sure, individual events can make a market move one direction or the other in a large capacity in a very short period of time, but they tend to correct very quickly as well, which Aaron alluded to, the correction in the cattle market that we've seen the past month or so. So those are some things to keep in mind as we try to travel through this. Of course, I always like to start with what cattle prices have been here in over the past year or so. Looking here at the 5-year average versus 2022 versus 2023, and it's clear the entire year we've had stronger prices than a year ago. And I don't think there have been many people complaining about cattle prices. Now, here's the finished cattle price, that 5-area live cattle price, trading around 180 last week. What will we do this week? It's still yet to be determined, but there is a power struggle between cattle feeders and packers right now. A lot of that has to do with the fact that there are a lot of cattle on feed. So the packers saying, "Hey, you got a lot of cattle, and we can back them up if we want to a little bit," and they are doing that to some degree. And I think the feedlot is going to benefit from backing up cattle, and we're gonna see these weights increase on these cattle because we're not going to have as many cattle down the road as we currently have on feed. But anyway, we hit about 190. We hit record prices this year, and I don't expect these prices to just fall out by any stretch of the imagination. I do believe that the price that feedlots are receiving right now, they can't afford to be paying $250 for an 8-weight steer to go in the feedlot. So when you think of it from that standpoint, I mean that would be $2,000 a head, and when you figure $1.80 on a 1,400-pound animal, the math just doesn't come out very well for a feedlot to make any money. Paying $2,000 for the animal, having $600 or more in putting 600 pounds on them, there's just not a lot of profit margin there. So that's something to think about as we move forward. Now we look at 5 to 6 weight steer prices out of Tennessee, freshly weaned balling calves. And, it's hard to complain about 240, 250, which is where we've been since June. I mean, we've had a 6-month time period in which folks could sell 550-pound steers for 240 or better. And when you're talking about $1,300 a head or so, again, producers in each of your counties, regions, areas, most of them should be making money in today's price environment. We have, compared to 2022, when we had excessively high input prices and very modest, at best, cattle prices, the current environment, I'm not going to say our input prices have softened completely, because we look at feed prices and I have not seen where they've softened, despite corn prices softening considerably compared to a year ago. I think we're starting to see a transition now that our feed prices are not always tied to corn price like we would have expected it to be 5 years ago, or even 3 years ago for that matter. So we're seeing strong feed prices, and that's the thing about these animals right here. They're still really, really strong prices. And if y'all know, in most of Tennessee, the drought that we're going through and the high commodity feed prices that we're facing, there's so many people already feeding hay that really they can't afford to pay much more than what they're paying. And actually, I would be willing to say that 550-pound steers in Tennessee may be overvalued in today's market. Similar, this is 7 to 8 weight steer prices in the weekly auction average. Strong prices. Of course, load lot cattle, which is how most of these cattle are going to be traded, are much higher, several dollars higher than this. But it just goes to show this would follow a trend of the CME feeder cattle index. We stressed, and we continue to try to stress this the whole time I guess I've been working with UT on taking advantage of when slaughter cow prices are strong. The idea of early weaning calves in August or September to let loose of those few slaughter cows that we know we're going to get rid of in a year instead of waiting until October or November. And right now that's cost, on average 10 to 15 cents for most people per pound. So you think about a 1,200-pound cow at 10 cents, that's $120 a head. If you'd early weaned the calf in August or September instead of waiting until October or November, really there's nearly a $20 swing in some cases. But if we're being kind of conservative, we're talking about $120 to $240, and there's really no way that calf over that 2-month time period made up that $120 to $240 by still being on the cow. So again, that's something to stress to producers very, very easily, very quickly. This is an easy graph to show them. It comes out in the weekly market highlights. This same graph does. And so, this is something to show producers, hey, you might want to consider early weaning those calves, those spring-born calves, because if you look at 2022, if you look at 2023, if you look at the 5-year average, $10, $15, $100, that's $120 or better a head. It might pay a little bit on that from that standpoint. All right, we're just going to quickly go through this. Heifer slaughter down 2.4%, steer slaughter down 5.4%, and beef cow slaughter down nearly 13%. We had extremely high heifer slaughter a year ago. We had extremely high beef cow slaughter a year ago. And so heifer slaughter being down 2.4% is not much of a decline at all, given the reduction in the calf crop that we had last year, and the beef cow slaughter being down 13% this year. This is because we don't have that many cows to slaughter across this nation. We have put so many of them through the market and through the slaughterhouse that this year there's just not that many to move. Beef production's down, pork production's up slightly, and broiler production's down slightly. Still a lot of meat out there. Can't stress this enough from just the information side and the expectation side of not getting caught up in propaganda that some people will write about, and you'll see it politicized in some form or fashion. And it makes me think, I'm sure some of y'all have seen where Biden has approved imports of Paraguay, of beef from Paraguay, and the NCBA and American Farm Bureau Federation and several others have come out just, irritated and agitated about this. And they raised the concern of foot and mouth disease. And I'm not saying that there is not a risk in all of that, but that was the same drum that was beat when they decided to allow fresh and frozen beef from Brazil. And what we're going to see is, because if I'm correct on this, this is not going to really increase the quantity of imports of beef that much, that change, because what will happen is, let me tell you what, let me just fast forward real quick to right here, imports. And you see the red line is Brazil, and all the imports that we receive from Brazil are primarily coming in the first couple of months of the year. And that's because we don't have an official trade agreement with Paraguay or Brazil, and thus they fall under the rest of the world quota. And as soon as the rest of the world quota is met, then all of a sudden import tariffs are increased on, or tariffs are increased on the imports of beef from rest of the world countries. So Brazil in the past 2 or 3 years has been meeting that quota very quickly, and then all of a sudden imports fall off. Well, Paraguay is going to fall under that same category, and so we'll see a bunch of imports of lean grinding beef from Brazil and Paraguay come January and February of 2024, and then those imports will fall off again from both of those countries because of that tariff that will be imposed on that beef. So just a thought there. But expect these imports to be above year-ago levels. They're going to be high in 2024 relative to 2023. And that's just simply because we're not producing as much beef, and we're going to import the beef that's needed to make all those hamburger products that all of you and I and all of our farmers and all the constituents in your county really enjoy eating. So on the export side, it's just the opposite story. We're producing less beef. We're going to export less. Our beef prices are higher domestically, so they're less appetizing to foreign countries. Now, that does not mean we're going to shut down exports altogether. It just means we're going to slow down. That does not mean demand for our beef is declining. It just means that we're not producing as much. Our prices are higher, and so that is a way of rationing what we're producing. I mean, that's really what price changes, supply and demand are all about. I mean, well, the study of economics in general, that's what it is. We're either moving across a supply and demand curve, or we're trying to increase demand or manipulate supply. Those are all things we're doing. And so price is how we control and ration what we're producing. On the export side, we still have China, Japan, and South Korea leading the way, with Japan and South Korea being those constant leaders. But China certainly has come in, since the Trump administration achieved some of their goals with trade with China. They still are a major player in the beef industry. And of course, you can't ever leave out our two closest neighbors, Canada and Mexico. And I don't know if Aaron still considers himself a Canadian. I mean, I realize he is, but I think he's very normalized into this U.S. So, well, sorry about that. I think I know exactly where we stopped, but anyway, just expect these exports to decline, and know that the cattle that we're bringing in from Canada and Mexico are really, really supporting what we're trying to do in this country. It's been a while. I tell you, box beef prices, choice box beef prices are really strong. I know the packer wishes they were stronger given what they've been paying for cattle, but when I started this job in 2012, we never broke $2 a pound on choice box beef, and then we broke it, and now, you know, finding ourselves below 250 is very rare. We did a couple of times last year, but it's rare over the past 2 years. And I don't know, you know, we've just had a slight decline under $3 for the first time in about 6 months. So I think we've reached a new level. We know that beef demand is strong domestically, internationally, and we're going to see these wholesale box beef prices remain elevated. And a part of that is the inflation that Aaron discussed earlier. Sure, we've seen a decline in inflation back to what we would consider typical inflation on a monthly or quarterly basis, but still 3%, a 3% increase in a big number results in a big increase. So think about how we're working through that. Let's just go through this. I hope all y'all's producers are going to take advantage of the programs with FSA and the dollars to be had through that. I think there's a lot of dollars that can help. Frankly, it's not paying you any, I mean, it's paying out money for the Livestock Forage Disaster Program, I think is the correct name. But people aren't making money on that. Given the situation we're in, you know, it amazes me how much we talk about stockpiling fescue, and I'd be willing to say that 95% of our state would have had zero opportunity this year to stockpile fescue. And so, you know, our late summer growth, all of our fall growth, even if you don't try to stockpile, you do count on some kind of growth, and we have not had that. So people have started having to feed hay earlier. And so those dollars are not going to be a money maker. Those are just dollars that'll help our folks purchase the feed that's necessary to get cattle through part of this winter. And I would say it's still going to cost them a few more dollars, but I would hope that they would go to their local FSA offices and sign up for that program. It's just something that, you know, we should spread the word about and make sure our producers are aware of it. Again, I mean, I'm still amazed checking with some commodity feed prices recently. You know, we're still looking at $340 to $360 a ton on some of these purchased feeds coming out of our feed dealers. That seems a little ludicrous to me, given the huge decline in corn. I was actually talking with a local corn producer, and the idea of, shucks, a lot of us would be better buying shelled corn from somebody than purchasing these blended feeds or these pelleted feeds, because we're probably going to get a better value on an energy basis. Now, if you need a protein supplement, that's another story, but knowing that a lot of our cattle are energy deficient as opposed to protein deficient, it might be a consideration to get a little more energy into diets just with corn in some form or fashion. I know that may not be an option for everybody or an alternative, but for some it would be. And at today's corn prices, if you're figuring $5 a bushel corn, you know, that's less than $200 a ton. I think it's probably around $1 or $1.80 a ton, maybe. I'm trying to do math in my head real quick. But there's 38 bushels in a ton or so, 37, 38. So you multiply that by 5, 38 would be 190, right? Yep, that'd be 190 a ton. Hopefully I did my math right there, but in my head. But anyway, so that's just something to talk with producers about as well, that if they're looking for an energy supplement, maybe that's the route to go. may be able to supplement some protein a little different way. Just something to think about from a cost standpoint. Hay price is not going to talk about really. Cattle on feed. Now, this is where I wanted to finish up right here. So you look at that dotted line, and that was 2022, and we had really, really strong cattle on feed numbers all year. And as would be expected, we had lower cattle on feed numbers this year up until recently. And the October cattle on feed is the second largest number of cattle on feed for October, I think, in the data history of the 30 years, whatever it's been. But this drought situation has forced a lot more cattle on feed. And so that's where the packer now has some leverage over the feedlot, in that the feedlot is flush with cattle. Now, what does that mean for the future months? Well, we're going to have fewer cattle to place on feed because we had a smaller calf crop this year. We're going to have a smaller calf crop next year. And so this is really going to tighten up those supplies, because we're forcing a lot of these cattle into feedlots earlier, and they're going to stay on feed longer, but they're still going to come off of feed at a certain time period. And so by the time next summer comes around, we're going to have fewer cattle on feed because we just don't have the cattle to put there. Now that, you know, we've had tremendous heifer retention from the standpoint of in the feedlot, as you can see here. We're putting heifers in the feedlot like crazy. So you look all the way back to 2011, and this is the highest percentage of heifers on feed as the total of cattle on feed. So, I mean, to put numbers on it, think of it as if we have 100. Well, let's just say we have 110 cows, because I'm going to do this on percentage basis, and a 90% calf crop on 110 cows would essentially put us right at 100 calves. Well, if you have 100 calves, then you would expect 50 of those calves to be bulls and 50 of those calves to be heifers. So if we were to put all of them on feed, if we were to put all 100 of those calves on feed, then there would be 50% males and 50% females. Well, if you were to take off 10 heifers, now we only have 90, and then you have 50 steers and 40 heifers. Well, that's a little more than the 40%. But my point of that is we're really only retaining about 10, 11% of our heifers for replacements. And in doing, even if it was 15%, what is our cull rate? What are typical cull rates of our 110 cows? Probably 15%. So you take 15% off of our 110 cows, and now we're not retaining enough heifers today to increase the cattle herd at any capacity. And the issue with that is we just got rid of a fall calf crop, and most of those are not going to be retained to go back into the herd. A lot of those will end up in feedlots. So we won't see any resemblance of heifer retention for probably 5 to 6 more months at best. So we've got a lot of animals, a lot of these females continue. Really, we need to be closer to 33, 34% to actually see true the percentage of heifers on feed relative to the total number of cattle on feed. To see expansion in this herd, we need to see something closer to 33, 34%. Still expensive to feed cattle. Despite that, if we went back to that corn price and we see nearly a $1.50 decline, you can see that the cost of feeding cattle has not declined as quickly. Here's the close for November. We've lost, $37 from the high, but easily. Most people could, realizing you can't always hit the top, if you see where we've essentially spent most of since the beginning of July, we've spent most of that time above 250. There was a 5-month period in which we were higher than 250, so that's $20 a hundredweight that price risk management could have helped us out on in some form or fashion. But hey, we didn't take advantage of that. And as I've said many times, it's when prices are high, is when price risk management, from the selling standpoint, is most beneficial. Looking at April, I think this is April. I can't see the letter up there. Is it J? I can't see it because of the. Anyway, I'm pretty sure I put April on here. Yeah, there it is. I'm sorry, right there. Current month, J, April. 234.98 again. $30 decline, $40 decline from the high nearly. There were some opportunities to lock in some prices, and we've got to take advantage of those and encourage people to take advantage of those. We got some quick price projections here. But let's go to what most of our people care about, and that's where we are. To wrap it up, I think we do need to be encouraging some of these producers to consider some LRP insurance. It's something you don't have to have but one head to do it, and I think there's some value in it. So with that, I will stop sharing my screen and open it up for questions.